For the past 6 months, I've been investing in the stock market every single month, $500. I have learned some of the most valuable lessons that are not always in the books, and I have also tracked everything and every data I needed to make this video. I've also found interesting similarities too, and facts. Let's get started. In this video, I'm gonna share everything I learned from my mistakes, errors, lessons, and what I plan to do next. Alright, first, stocks are unpredictable. Here are 7 screenshots taken every month from every video I've made, and as you can see, none of them look like the others. Every time something made their price move to the positive or negative side, and that is something you can hardly control. I mean, not at all. The price of a stock has nothing to do with its earnings, or in other words, it is the price versus the value, and not the price equals the value. And once we get that, we will understand at least half of investing. Sometimes the stock will go up because more and more people say that it went up, so they think the stock will continue to go up. Sometimes the company will buy another company, so its price will move again, or layoff that are both a good and bad sign for the company and its price. So if there's one thing I learned for the past 6 months, it's that the price you buy does not reflect the real or intrinsic value of the stock. So when I invest in a stock now, I must look at the data behind rather than the evolution of its price. For example, here's the price of Microsoft for the past 5 years. Looks good, right? But it lost roughly 30% of its value in 2022 alone. Why? Well, most of the time, if a company does not make money, that means investors will not stay in the business and sell. But as you can see, they've consistently grown their earnings at an impressive rate of 30% a year on average. They are also buying back their own shares, which is a good and positive indicator. And they also have been paying dividends continuously for more than 18 years now, without interruptions. In fact, the 500 biggest US companies lost on average 20% of their value because of a recession that made assets go down. So yeah, these screenshots clearly show that nothing is predictable and that we better look at the stock itself rather than its price. Alright, next, price and earnings are all that matters. And that is only true if you combine both to have the price to earnings ratio. And this ratio alone gives you a raw view of the stocks. You can find it on most websites. I like to use Google Finance for that. It is this number right there. And usually the average is 20 to 25. So if a stock is lower than that, it might be undervalued. So the stock might be worth more. If a stock is higher than that, it might be overvalued, so the stock might be worth less. And it can also depend on the sector itself in which the stock belongs. For example, I have seen that the lower the P/E ratio, the better my stocks and the higher it got. My first 5 companies are also my top 5 worst investments. That is not entirely true for Apple, right? But Johnson & Johnson lost 30% of its value in 6 months, Procter & Gamble lost 5.5% of its value, and McDonald's didn't take off either, minus 0.50%. And they all have a high P/E ratio of roughly 28, when 15 should be, I think, our target. And keep in mind that the lower the P/E ratio, the better. Alright, lesson number 3. Selecting stock is not what you think. So the phrase itself is pretty blurry, right? So that means investing is quite hard and there's no way around it. It takes time and effort to learn. There is one way to make it easy. We'll talk about it later. And I would say that there are 3 steps to becoming a better investor. 3 steps that anyone can start and master in a few months, as I did. The first one is acquiring knowledge. And that is the most basic thing anyone has to do when learning something new for the first time, right? We have to know how the stock market works, why, what is investing, how to invest, and we have to understand diversification, sectors, dividends, and some other metrics too, etc. And the single best way to understand all of that stuff is by reading books. So that seems pretty common and easy, right? But at the same time, not enough investors practice this skill. And that is why stocks are going up and down every day. People are irrational. So I would recommend The Psychology of Money to start, and Rich Dad Poor Dad. It will give you a broad idea of how investing works and break down the fundamentals. Alright, the next step is action. So at that point, we should all have everything needed to understand and at least start investing. And technically, there is one easy and better way to start investing in the stock market. It is called the S&P 500. It is an index fund that tracks the 500 biggest US companies, and historically, it performed very well, between 10 to 12% a year on average. Sometimes it went up, like plus 25% a year, sometimes it went down, like minus 25% a year. But for the past century, the average is around 10%. And this is the real truth about investing. If you want to make it easy, just invest in the S&P 500. So what if right now we start to invest $500 in the S&P 500 for the next 10 years? So for the past 6 months, I already deposited $3,000 on my account for an estimated rate of return of 12%. And as you can see, 10 years from now, in 2042, I will have invested $63,000 for a total interest of $62,000. In 10 years alone, you can double your money without any hard work or extra hours put into investing. And let's quickly crank this number up. from 10 to 20 years. So in 20 years you will have more than 500k, and in 30 years you will have close to $2 million. And the hardest thing by far is to wait for those 10 years to happen. And that is pretty cool, I think. Anyone can earn lots of money while letting others win too. Finally, the third step is to acknowledge your mistakes. So one of the best ways to learn is by experiences, right? And mistakes are part of the path to investing. They, in fact, are the path to investing itself. So we have talked about the easy way to invest in the stock market, right? Now let's talk about the hard way to invest in the stock markets. And this is called individual stocks. So rather than choosing one single ETF, you can yourself choose each stock you want to buy and thus decide what to keep and what to avoid, which is not possible when you invest in the S&P 500, for example. And this way of investing is not recommended to everyone because it takes time to read every annual report, compare the stocks, read even more books, talk to people who know the stock better than you do, etc. And there are thousands of things to consider, choose, and avoid in an individual stock. So the first thing is to look for emotes. For example, Coca-Cola has a very good brand recognition around the world. Studies have shown that most people would often choose Coke over other choices they have, which gives Coca-Cola a reason to invest in it. Then you have to look at its management, how it makes money, and other metrics too. And I would also look at the dividend payout for at least the past 15 years. And if you don't find anything about dividends for the past 10 to 15 years, it probably means that it does not pay dividends at all. Also, look for stable and consistent earnings, good debt to equity ratio, and finally, assets to liability ratio, and so on. And if you have enjoyed this video and want to know more about investing, here is my Invest With Me series. And if you want to know how to evaluate a stock, the video is right here. Thank you so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.